Welcome to episode 44 of the Minds Capital podcast, the show devoted to the growing world of independent sponsorship and entrepreneurial private equity. I'm Will Smith, here with my partners in Minds Capital, Nicholas James and Max Lemus. Today's conversation is with G.R. Kearney of Stacker Holdings. Max, what did you think of our conversation with G.R.?
I thought GR has a very fascinating story up to this point. He's the only inner city school teacher turned independent sponsor that we've had on the podcast so far. And it was just great to hear how he went from his first profession into independent sponsorship and how he made that connection. That was unique, and that sort of set the tone for the overall podcast. I found it interesting that with his portfolio companies, he uses EOS, the Entrepreneur Operating System, which is a framework for basically managing the business and getting employees to buy into the company and row in the same direction. I think a lot of sponsors are doing that sort of inherently, but this is the first time I've heard EOS directly cited, and GR actually said that he can't imagine buying a business without implementing EOS. So I thought that was a powerful statement and something probably worth looking into for other sponsors, whether they're sort of doing that already inherently, and it's not just called EOS or not. I think it's something probably worth looking into. Along with that, he talks about employee ownership, not just equity ownership, but really getting employees to buy into the business and to row in the same direction. And I think you have to probably have some form of EOS implemented. You have to have some sort of framework to manage and measure and to share that information with the employees along the way so they know how the business is performing and they get to the point where they believe their own contributions are worthwhile and helping the business grow. And, once you get employees to start taking ownership in the business and to start thinking on their own about how to improve the business, then you've really got something. You've really got a very strong moat with your culture. So those two items that GR mentioned were powerful.
Yeah, he was really enthusiastic to talk about the employee ownership. We asked him that on our way out of the interview. I think it's the last question. And he says, "Oh, you saved the best for last." So it's clearly where he brings a lot of passion. He talks about the results of instilling that employee ownership just being obvious and strong. He talks about the KKR playbook. I think, Nicholas, you and GR go back and forth on this and how eager he is to get his hands on it, because apparently KKR has some playbook they use here to build culture and build employee ownership. Using your word there, Max, culture, really this is just another way of saying culture, but there is some secret sauce, it seems like, that GR and his partner have started developing that's really working. And also, the EOS point is a good one too, Max. I hear about it constantly in Searchland on the acquiring minds side. EOS is a very common feature, and in hearing GR talk about it so enthusiastically only surprised me in that we don't hear about it more often from sponsors. I don't know if that's just because it's low level and sponsors are thinking, up here, or sponsors use it less, or what. But it did prompt me to wonder why we haven't heard EOS mentioned more by our sponsor guests on the Minds Capital podcast. Nicholas, what did you think?
Just one point there on the KKR playbook. I don't know that GR had gotten his hands on the playbook, but 60 Minutes did a feature, which you can find online. It's called Private Equity Heavyweight Pushing Employee Ownership. And it's a quite nice little segment that 60 Minutes did on KKR for this particular item. As far as the interview, we talk quite extensively about what to do if one of your partners pass away. This unfortunately happened to GR and Austin, who were at a previous independent sponsor shop before they started Stacker Holdings. And so we talk about the implications of that happening, how to safeguard, how to write your LLC agreement. I think one element that didn't necessarily come up, but that I have seen at the OpsCo level for this is key person insurance. And so when you buy a company with a CEO or some key people, it's quite common that lenders will require you to get insurance, often in the amount of a term life insurance, in the amount of the loan itself, based on the key people. And the company will then be paying out of operating expenses for that insurance on an annual basis, but it gives everyone a safeguard against being hit by a bus or dying in an accident or whatever it would be. And I think at the holdco level, you could probably do some version of this as well. So you take some of your management fees and pay insurance. So you have D&O insurance over here, and then you may have key person insurance on this side. And I think it could be well worth it. You can reassess the value of that term life based on your portfolio at any given time. But this could be a clean way to buy someone's estate out if something was to happen. And I haven't heard anyone apply it. We don't have it at Minds Capital, but it was just something that came up in my mind after we had talked to GR, who was very generous in sharing about this the situation that they went through many years ago now.
Yeah.
If I may, I just wanted to do, on a lighter note, I wanted to do a quick shout out to my good friend Mike. We swim every Wednesday morning here in St. Pete, and a couple of weeks ago before Thanksgiving, I asked him, hey, what kind of music do you listen to while you're working out? Because he always has a headset on in the pool. And he's like, I'm not listening to music. I'm listening to you guys. And so it turns out he's listening to our podcast every week when we swim. So shout out to you, Mike. And one day I'll catch up and beat you in the pool there.
Well, before we get to the interview, everyone, a reminder that Minds Capital does invest in independent sponsor deals. So if you're a sponsor with a deal under LOI, send it over to us. mindscapital.co is our URL. And if you're interested in investing in Minds Capital as an LP, there's a pre-registration form also on our website for accredited investors. One more time. And if you're interested in investing in Minds Capital as an LP, there is a pre-registration form for accredited investors also on our website. So if you are an accredited investor, you can fill that out to be kept in the loop on our fundraisers and how to become an LP. And here is episode 44 of the Minds Capital podcast with GR Kearney of Stacker Holdings. Enjoy. Welcome to the Minds Capital podcast, your connection to the growing world of independent sponsors and entrepreneurial private equity. We are your hosts, Will Smith and Nicholas James. Based in Chicago, GR Kearney was an English major as an undergrad, then went on to be a teacher at an inner city school on the south side of Chicago. He's been an independent sponsor since 2007, first as an employee, later as one of the founding partners of Stacker Holdings that we're going to talk about today. One of Stacker's portfolio companies, Acme Finishing Company, has been held for a decade and generated well over 3x MOIC from distributions alone. Philosophically, Stacker Holdings are big advocates of EOS and place a strong emphasis on employee engagement. GR, welcome to the Minds Capital podcast.
Thanks, Will. Nicholas, thank you both for having me.
GR, I touched on your background there, which is a bit unusual for our guests. Please fill in some of the gaps there, going from teacher to employee of an independent sponsor to now a sponsor yourself.
Sure thing. Yeah, I imagine I'm one of the first people that started their career as an inner city teacher that's been on the podcast. But so for me, my journey, I was an English major as an undergrad, and then chose to spend my first 2 years out of college teaching at a school called Cristo Rey Jesuit High School on the south side of Chicago. I also did quite a bit of writing, some book-length writing projects while I was there, one of which was about the development and growth of the school. And through that, I interviewed a venture capitalist named BJ Casson. The first question I asked him is, what is venture capital? How does it work? And it fascinated me, challenges a bunch of my notions about business where I had naively thought, being in business meant you were a suit-wearing corporate automaton and didn't do anything interesting all day. And quite on the contrary, BJ's career had been fascinating. Literally that night after speaking with him, and it was one of those conversations where I wouldn't say a light bulb went off, it was like flash bulbs popping. I signed up to take a GMAT test prep class, and maybe a month or two later took the GMAT, and then shortly thereafter applied to MBA programs with a desire to get into direct private investing. And then in the wake of finishing my MBA, I was able to wiggle my foot in the door at a private equity firm, which was an independent sponsor called Acuity Capital Partners in Chicago. So hopefully that connects the dots for you.
The private equity firm that you ended up at, the independent sponsor, is that the same independent sponsor that you were then an employee of?
Yes. Yep. I've essentially been doing the same thing in the same place since I finished my MBA in 2007.
So tell us a little bit about evolution from employee to now principal.
Sure. Yeah. Unfortunately, there's a tragic element to the story. I was hired. I was employee number one at a small independent sponsor shop called Acuity Capital Partners. Worked with the founder for 11 years. At some point, transitioned from being a true employee to at least economically being a partner. The reality of that situation was that I was working in someone else's business and working for a founder of a business. The founder tragically and unfortunately died in an accident in 2018. We then we'd made another hire. My now partner Austin Reichart was our junior guy analyst. He maybe had a title of VP by that time, but he was the junior guy in the firm, and the two of us made the decision to partner together and go forward. We eventually rebranded the business as Stacker Holdings. And that's essentially how, and at that point we were co-founders of an independent sponsor shop together. And I would say at that point very much felt like the principal as opposed to the employee.
And to be clear though, that the portfolio you somehow inherited or transitioned?
In the wake of Justin's death, we worked very closely with the executor of his will and estate, which was his sister, and the family's desire was to liquidate as much as possible. So there were 4 portfolio companies at that time. 3 of them were sold off. There was one investment that had been made fairly recently. We were able to raise capital and hang on to the investment, but provide liquidity to the family. So one investment was carried forward out of that. The other 3 were sold off. And then Austin and I have continued to work with the one that we inherited, have bought 4 more since then, in addition to a number of add-on acquisitions, and then are under LOI with what would be a 6 portfolio company at this point. And then you alluded also to how did you disentangle and the messiness of it and so forth. And if I were going to give kind of one PSA through this podcast to your listeners, especially those that maybe haven't started or in the early stages of it, if you're doing this with a partner, and even if you're not, probably it makes a lot of sense to be thoughtful and intentional about, one, how you and your partner might separate at some point. Contemplate that at the beginning when everything's going great and you're getting along well. And then similarly, think about what happens if one of you dies unexpectedly early in the process. Our previous partner, Justin, had not given a ton of thought to that. He'd had some life circumstance changes a couple years prior to that at least created a little bit of a foundation. But in terms of kind of robust planning or end of life planning, he was in his late 40s, early 50s, perfectly healthy. It was not top of mind for him or us. And when it does happen, if you haven't done the planning, I think the unwinding is slow and inefficient and can be painful. So the more upfront thinking, and obviously contemplating your mortality when you're 32 seems crazy and unpleasant, but it's 100% worth doing. And I can tell you, I am taking my own advice. It's taken years, but Austin and I are in the throes of kind of working through how do we get this stuff written down. It's not fun. It's complicated. It takes a long time, but it's a worthwhile endeavor, I think, if you're serious about being in this business for a long time.
How do you imagine this is different when you do business on a deal-by-deal basis compared to, for instance, if you were employees in a fund of Justin's? How would that have been different in terms of disentangling?
I think it'd probably be a lot easier if your employees in a fund. I think the fund documents are going to govern essentially all of the portfolio companies, and there are probably mechanisms in there to deal with a lot of this. When you're going deal by deal, there's a different operating agreement. There's oftentimes a different economic arrangement at every deal. There's different control provisions, different partners, different lenders. There's a lot. Each situation has to almost be dealt with independently, and a little bit more complexity, I think, and then probably somewhat fewer resources at the independent sponsor shop in order to go deal with all the complexity than you might have in a fund.
I was actually hoping you would say the opposite, and your point is well taken and correct, I think, now that I heard you say it. But I was thinking you perhaps would say that since it's not a fund, there's nothing to disentangle or untangle at the holdco level per se. And so you just have to deal with each of the, in this case, 4 portfolio companies individually. And in your case, you sold off 3 and recapped the 4th one, and then you're kind of home free after that. So isn't there something to be said about the flexibility?
There's definitely flexibility. So I'll talk a little bit about how Austin and I have tried to think about it in terms of, I'm 10 years older than Austin, so let's assume that I'm the one that gets hit by a bus before he does. We're essentially equal partners in all these businesses economically. Whatever share has accrued to Stacker, we've divided evenly, and then at the kind of management co-level, it's the same way. And we've had plenty of people advise us this is the wrong way to do it, and we threw caution to the wind, and that's how we've set it up. But thinking about then, if Austin did not get into business to be my wife's partner, so if I were to die, we need a mechanism for him to try and, I would like for whatever value's been created to there'd be a way to get that if he's going to try and pull that back. So building those mechanisms, there's some value at the management company level. Then there's this value that we're sort of holding separately and independently at each of the operating company levels. And how do you think about valuing that? We're trying to use insurance as a mechanism to make it much easier to sort of transact relatively quickly. How do you size the insurance to the value? Having never worked in a committed fund environment, I guess I can't speak definitively to one being easier than the other. Our experience with this has been, it's not simple. Requires a lot of thought, unfortunately, and it's not particularly fun stuff to work on relative to going out and spending time at one of the businesses or working with the people in the business, et cetera. But
as you are,
needs to be done.
Yeah, exactly. And so as you are planning, and I think this is more proactive than the average partnership out there, but as you guys are scheming what that could look like, who are the advisors that you loop in, and what are the documents that you're actually at the end of the day signing?
So we haven't signed it yet. We're working on it now. We're working with our law firm. Fortunately, they do all of our deal work, but they've got a broad range of services and general business counsel and estate planning and so forth. So we've got those folks pulled into these conversations as well. We both have accountants that we've talked to. I'm trying to think. I mean, each of us has been bouncing ideas off folks in our network as well, but it's primarily been relying on attorneys and accountants to help think through tax ramifications and legal structuring.
And it's an operating, so it's the LLCA, the operating agreement that you have at the Stacker Holdings level that you are modifying to accommodate for these items. Okay.
Correct. And then trying to create a framework through which, so none of the interests in the various portfolio companies are held at the Stacker level. So trying to create an operating agreement that creates a mechanism to go transact on those interests that are held down at the operating company levels, at least on the promoted units.
And so you and Austin are good friends and have been colleagues for many years. What would you say have been some of the more contentious points as you guys are working through this agreement?
Fortunately, so we haven't really run into any contentious ones. I would say more what we've run into, and we're very aware of how little of this stuff we really understand. I think it's more that we just get stuck and say, well, I wonder if it's meant to work this way or that way, or if we did this, are there going to be some unforeseen tax consequences we have no idea about, and we kind of get stuck in the mud on those things and go try and get some outside counsel. We haven't bumped into anything yet where we've said, I just, where we see things entirely differently. I think both of us, I feel incredibly fortunate to get to work with him. I would say when we have been in positions where there's been disagreement, I've been arguing something from his perspective and he's been arguing it from mine, or we've been trying to be overly generous with the other as opposed to advocating for either of ourselves. So we haven't hit a spot where there's been major contention. Fortunately, may happen, but it hasn't happened yet.
This is probably one of the benefits of being 50-50 is that you each, whatever you agree on for one party is, there's perfect parity across to the other party. Whereas if there was an imbalance, it might make, a 70-30 dynamic more difficult to negotiate. But just to be clear, GR, so what you're trying to agree to or come to terms on at the operating the sponsor level, sponsor operating company level, would be the same, would be copied and pasted into each of the portfolio company, operating company agreements. Is that the model?
Yeah, yes, effectively, yes. In theory, it's almost like a waterfall structure where, we value the stacker level. If there's something left over in those proceeds, it would flow down to oldest portco, and then if there's some left over that, to the next, to the next, to the next, and then we're trying to figure out what happens with whatever's left, and the insurance proceeds run out, and what happens to the value that's left. That's where we are in the process. And again, it's more been a journey of, geez, I've never thought about any of this. And again, if there were two people in the world, given our proximity to a tragic and untimely death, who should have thought about this almost immediately, it would be the two of us. And the fact that we're almost 8 years on from this and only getting to it now, I think is proof positive that it's hard stuff to deal with. But it is bad things do happen occasionally, and I hope and pray they don't happen to me, but I'm trying to make sure we've got stuff arranged so that it'll be less chaotic if it should it happen again.
Yeah.
What hypothetically would have happened if you as employees stepped away at that time? Hey, you lost the founder tragically, but it's at the end of the day your employees, and it's not really your fiduciary duty directly to steward these companies towards exits or recaps. Like, well, what would that scenario have looked like?
So that's a good question. I haven't thought too much about it. I would guess that the executor of Justin's estate, who is his sister, would have likely had to have taken a much more active role in the management of the investments. Fortunately, there were good and functional management teams in place at all the businesses. So I remember she called in a panic. Maybe Justin died on a Friday. She might have called on Sunday and said, so do I need to be there to sign payroll checks on Friday? I was like, no, it's not. So there was this, hey, wait, we own these private businesses. What the hell was happening? And do I need to be picking up the pieces? And so I think that was a huge relief. It's we'll cover whatever needs to be done. You take care of the stuff on your end that you have to do. But no, the businesses run, and but it would have eventually, right? It was probably a matter of weeks before there were requests or things we had to do. Just the sludge of owning and operating and administering a business, a bunch of things pile up, and that would have all piled up for her, and there would have been a ton of inefficiency and trouble sort of figuring out how to find that information, access it, get it, and would have likely harmed the businesses in some material way if we had just ghosted, I think.
Well, GR, turning now to a little bit lighter fare. So when you guys set out to do Stacker, kind of maybe version 2 or whatever was birthed from the early years, and now into this new partnership, what were some of the kind of approaches that you set out to build? You had experience now in an independent sponsor firm, so you probably had some ideas about crafting the firm exactly as you'd want it to be, and here was your opportunity.
Yeah, very much so. So I think first and foremost, there was conviction that there's quite a bit of opportunity in the lower middle market. We had felt that previously and continued to feel that way. So that underpinned the whole thing. And then on a go-forward basis, we wanted to build a business that was probably less reliant on debt. So we've tweaked where we might have been putting in 20% equity in the old days. We tried to move that more to 50-50, tried to go up market slightly in terms of size of business and quality of business. I joke that Austin and I said, if we do this right, we will never have to have another conversation where we're trying to explain what a CRM system is and convince someone that there's beneficial to have one. Like ideally, we move past the businesses where you have to debate that, because it's just
I've never heard that as a filter, but it's a good one.
It's a proxy for all kinds of inane stuff that you end up so far in the trenches and in the weeds that you're just probably not working on the things where you really can move the needle if you're debating a CRM system. I wouldn't say it's worked out quite the way we envisioned. We still end up having conversations like that. It's not always directly CRM related, but I think the theory was right, and we were probably able to move towards stronger, more sustainable businesses than what we had been doing in the previous iteration.
We touched on your emphasis on EOS, employee engagement. Were those also features that at the outset you embraced, or did those evolve over time? And just really expand on why those are such a feature of Stacker.
Yeah, happy to. From an EOS standpoint, when Justin was we discovered EOS with Justin when he was still alive. So we first started on our EOS journey right around the time that we acquired Acme, which was in 2015. Acme is the oldest of our portfolio companies, and maybe we'll talk more about it. But so it has been over a decade that we've been on EOS. We were rolling it out, or had rolled it out to the entire portfolio at the time that Justin died, and I think Justin was a believer in it as well. With the benefit of hindsight, we were probably sort of, tromping around on the top of the iceberg a little bit with EOS. I think we have learned a lot more about it in the intervening years and have a deeper appreciation for both the simplicity and the power of it. At a super high level with EOS, I can't, when I am occasionally in other parts of my life, not-for-profit, board work, whatever, when I'm in meetings that aren't running on EOS, I oftentimes find that I want to just slam my head against the table. EOS has just pushed us to have meetings that are good and useful, and when we come out of them, people are accountable for getting stuff done, and when we all gather a week later, it's either been done or it hasn't. And I wish I had more of a detail orientation and kind of conformity in my life, but that structure forces me to try and get things done. It also is a fantastic framework and it's really pretty basic and simple, but it's a fantastic framework for getting people on to the same page and working toward a shared vision and an understanding of where we're going and what we think is possible. And if you can get those things right, and I think this is really relevant for independent sponsors who may be buying their first business. If you can get those things right and get people on the bus together, headed in the right direction, you can really start to make things happen. If everyone thinks they're going a different direction, it's really hard to ever move forward in one way. I could go. I'll stop there and see if you want to double click onto EOS, but it has given us a common language and a common framework that we can apply to all these businesses. And I truly can't fathom operating these companies without it.
I will ask a follow-up on EOS there, GR. So let's assume that everybody agrees that the value is obvious and it could even be part of a sponsor's playbook. Any business you buy, in goes EOS, one of the first things or one of the early things that's done. What about employee embrace of it? Do you ever encounter resistance to EOS? And if so, how do you get over that?
I wouldn't say we've had I wouldn't say we've had vocal resistance. That doesn't mean there hasn't been some resistance there. I do think the accountability, and when we talk about it, we talk about trying to create a friendly culture of accountability, right? We're not yellers or screamers. It helps us hold ourselves accountable, and we think it helps hold the organization accountable, right? But there are people who the idea of being evaluated on some level on a weekly basis on whether or not they got done the things they said they would get done, they just bristle at that. And typically they self-select out. That's been our experience. There usually aren't prolonged debates about it. I do think Austin and I are, we're both relatively young. I'm 48. He's a decade younger. We're aware of the fact that when we show up at these businesses, we can be perceived as, who the hell are these guys? And do they have any idea what they're doing? And then if you walk in with a bunch of acronyms and log into this and do that, and we're going to do everything this way now, that can be tricky. We have kind of, for a while, we self-implemented, and we've gone back to trying to utilize the certified EOS implementers. I think oftentimes they have more gray hair than we do. They can speak to the results that they've gotten through EOS, the results they've had in their career. And to some degree too, if they're going to fire arrows at somebody, the arrows end up going at them, and we put ourselves in kind of as in a role as consultative and a partner, and we can always swap out an implementer if it's not working. And I think we found that to be a little bit more fruitful than doing it ourselves. Once you put yourself in that position, you may not be getting feedback about what's working and what's not working because they fear that you're going to take it personally, et cetera. So I think that's been a better playbook for us than trying to do it ourselves, which we did do for a while.
What, tactically speaking, let's say you read the EOS book, you've heard your advocacy of EOS, you decide this is something I want to do as well. It's not a switch that you turn on and off, right? So what are the steps in order to become an EOS operating business? Do you hire one of these consultants? How much do they cost? What are the meetings and the meeting cadence that you set up? Can you describe the tactical elements of how you get started with the implementation?
Yeah, I don't know that I have the exact program memorized, but essentially, yes, you can go to EOSworldwide.com, search for an implementer, interview a handful of them, and we've just recently started working with two new ones at two new portfolio businesses. They'll come in and do an introductory meeting, no charge to that. You get a feel for the person. Is this someone I can work with, et cetera? And then once you decide that you want to do it, it's probably over a period of maybe 3 meetings over a period of 120 days. And then you click into kind of a quarterly cadence. So really EOS becomes a quarterly check-in system. And then there's one of those quarters you do annual planning or budgeting. And then every week you're taking the leadership team at the company and you're meeting in a fairly structured, regimented meeting that kind of follows along these EOS guidelines, where you're trying to get through all the administrative stuff, reviewing to-dos, and to get to a point where you're working on and solving issues in the business, essentially. So there's a transition period into it. A couple days, I forget the exact names, Vision Building Day 1, Vision Building Day 2, I think, and then you click into the quarterly cadence. I think that's it. So there's a little bit of a cluster at the beginning. I believe those implementers charge generally between $4,000 and $7,000 a day, so it's not inexpensive. If you can find one in your hometown, you don't have to pay for travel or other. Our experience has been, though, that there's definitely a return on it. It accelerates everything that a sponsor would be trying to do on their own.
GR, you'd mentioned Acme. Can we hear more about this business that I touched on in the intro and that's been your longest hold and the one holdover from the Justin years?
Sure. Happy to talk about it. This one's near and dear to my heart. I ran the business for 7 years and have deep relationships with a lot of the people here. But so the quick story on Acme, we bought it in 2015 for $7.5 million. It was, we had hoped it was doing 1.8 in EBITDA. There was kind of a bad beat during diligence where we knew that number was going to drop due to a customer departure. So we bought somewhere probably between 1.3 and 1.4 of EBITDA. We bought the business from two brothers who were third generation owners in their 70s, very much ready to move on and retire from the business. And we hired an outside manager. We closed in August, hired an outside manager by October to come in and run the business. And 10 months later, earnings had fallen by 50%. And we made the decision to move on from the manager. We did that somewhat hastily. I had led the investment for our team, and I don't know if I volunteered or was voluntold, but I ended up running the business for what was supposed to be kind of a 3 to 6 month period. And the general thinking was, go be nice to everybody. We were concerned that really good key people were frustrated with our new regime and were in various stages of preparing to leave the business. Some were drug testing for the next job. One had moved on. Others were pleading to the one who moved on that, hey, take me with you. So the goal was just go in and be nice, obviously without a giant bag of cash to kind of throw at everybody to get them to stay. Be nice, convince people that the future is going to be brighter. We ended up with a couple quick early wins. Between that and then Justin's tragic and untimely death, and then COVID on the heels of kind of emerging from some of the confusion. And it was a couple of years of work getting things tied up in the wake of Justin's death. And then right as that drew to a close, that was January of 20. I remember thinking like, we're past most of this and can really focus on the business. And then Rudy Gobert got COVID, and the world changed overnight, and all of a sudden PPP. So those two things extended the time that I was here quite a bit. Fortunately, during that time, we had a good deal of success. The business grew significantly organically. We more than doubled revenue.
What's the business do, GR?
So it's a contract metal finishing business. We apply powder coat and wet paint to metal parts that are typically manufactured by someone else, occasionally plastic parts as well. So we're deeply embedded in a bunch of global supply chains. Sometimes we're contracting with OEMs and sometimes with their supplier networks. Generally, it's recurring revenue. Trucks come every day or every week or every month. Nice, stable, very diverse group of end markets. So electrical infrastructure, consumer products, et cetera. The business has grown nicely. Revenue doubled from that low point. I think earnings grew probably 600%. I stepped back from the full-time operational role in 2023. We promoted the gentleman who is running the sales effort here. He's far better at being the general manager of this facility than I was. I'm focused on doing M&A work now. We've subsequently done 2 add-on acquisitions, one small one that we tucked into our facility, and then we bought another finishing business in Benton Harbor, Michigan that's a wholly owned subsidiary of Acme now. So we're up to 25 plus in TTM revenue and 5 plus in TTM EBITDA, and trying to figure out where we go from here.
What are the options other than exiting? You have a long-term orientation, don't you? Or a long-term hold orientation?
Yes. So I think Austin and I have a bias toward longer, broadly speaking. Our view is if you've got one that's working, things start to compound the longer you hold them. A lot of that early work that didn't yield much, you start to see returns on that later in the process. So we're generally not in a rush to move on. I think we've also found that as we've gotten operationally involved in the businesses, you also build relationships with the people in them. So we talk a lot. These businesses in an MBA curriculum, they will often be referred to as assets. To us, they feel much more like organisms than assets. And a kind of clear, concise exit is can be harder when you're talking about an organism and not an asset. But that being said, I mean, I think options for us at this point are investors. Out of fairness to our investors, we have to consider an exit of some kind. They didn't sign up to be in this indefinitely, or at least minimally some path to get them liquidity. We've found in some of the conversations that we've had, there seems to be more interest in the business as kind of a continuation or extension of what we've been doing than just an outright sale. There seems to be a bias toward, if you've got a sponsor that's had something that works and thinks there's work yet to be done, there seems to be interest there. So we've got one under LOI right now that we're trying to get closed, unrelated to Acme, and I haven't worked on it a ton yet. Maybe more information than you want, but we were pursuing a large add-on acquisition and ended up having quite a few conversations with potential capital providers for that acquisition. And through that, I think developed an understanding and appreciation that there's quite a bit of interest in potentially recapitalizing Acme. There seems to be a preference to have, sort of a continuation of sponsor involvement. And I think that would make it harder for Austin and I to slide all the chips off the table.
You're talking about a recap of Acme now after 10 years. Is that from the lender who wants out and the loan is maturing, or is it on the equity side, or both sides?
We have an SBIC that's been in this deal with us from the beginning, Salem Investment Partners, down in Charlotte and Greensboro. They're fantastic. They've just been wonderful partners on this deal. They're investing out of Fund 6, and this is one of 2 deals they have left in Fund 3. So they do have time considerations. At some point, we've got to get them liquidity. They're also, they have a large equity stake in the business as well. And then similarly with the rest of our equity investors, I think we have numerous people that are in their 80s. And I think as we think about how to grow the business, it's a fragmented market. There's an opportunity to consolidate. Our investor group is at that point where if they're going to open their wallets, it's for money to come in and not for money to go out. And if we do want to go grow through acquisition, we probably need a different capital base in order to do that. Fortunately, no one's really pushing it, Nicholas. We're just at a point where I think forward progress in the business probably depends on a different capital base.
It's an organism that needs a shot in the arm.
Yeah, from a capital standpoint, probably.
And so how does that work with regards to valuing the company? Because you're now the seller and the buyer of the same company as anyone who does an equity recap is. So how does that step-by-step work?
Honestly, like it'd be much easier if all the interest was from folks that just said, hey, buy the whole thing lock, stock, and barrel and everybody move on. If you end up in a position like that, ideally, you'd have a couple interested parties and could sort of get a market test. We have a decent handle on where businesses like these trade. And I think ultimately the way Austin and I have gotten comfortable with the possibility of that would be we would insist upon any investor who's in with us today, if they wanted to reinvest, they would be welcome in the go forward vehicle. And I think at that point, if you're saying, hey, here's an opportunity, if liquidity is important to you now, we believe this is, we're sellers and buyers on both of these transactions. We believe this is fair. We're willing to accept it. We're also willing to reinvest on the terms of the buyer. We understand your perspectives may be different. If you'd like to stay in, we would love to have you. If you want liquidity, no hard feelings. It's been a decade and you've been awesome. But it feels like as long as they have the ability to choose, how we arrive at the number becomes somewhat less important. As long as it's a number, I think intellectually for us that we can say, yeah, this makes sense to sell at this level, and this makes sense to buy back in at this level too.
I have to imagine Salem being a big equity partner, but also the debt provider. They want out. You mentioned that. And so they're probably an active part of this conversation. But isn't there also a little bit of a conflict in your head? Because on one side, you're selling this deal to prospective new investors. And so you certainly don't want to pay above market, right? On the other hand, you get carry and economics related to the exit. And so you do want above market if you can get it, right? And so how do you balance that?
Yeah, so that's a great question, and we haven't gotten very far down the path. I think at this point, what's become abundantly clear is the level of interest seems higher with our continued involvement. So I've sort of been operating from a mindset where we're trying to get a good outcome for the investors. It feels like continued involvement probably becomes the best path to do that. But to address your question, let's say we had an offer from a third party that wasn't interested in us, that far surpassed what whatever value we had kind of arrived at or agreed upon. I think you'd have to take that. You'd either have to take it or match it, right? And again, if the new LP is going to turn to me and say, our expectation is that you roll a significant majority portion of the proceeds from this, certainly I'm going to be discerning as a buyer. I know these businesses reasonably well. I'm not going to over lever what becomes a very appreciable portion of my net worth. So I would be cautious and careful as the buyer. Yeah, I mean, I think we're in a good position in terms of having knowledge of both sides and having good market knowledge. But if you get someone that's willing to, from my perspective, overpay, it would probably be hard to say no on some level, right?
Of course, having a third party unsolicited come and give a fair market valuation would be an easy and external way to do it. But in the absence of that, I guess you're seeking the point where theoretically you would be indifferent between being an investor on the way out or an investor on the way in. It should be an equally good deal for both of them.
Exactly. Yes. That's been our thinking on it. But yeah, third party appraisal, obviously I imagine that probably ends up happening either way, was to validate where you landed.
And so the investor dynamics, you said in the intro, Will said that you guys have already distributed dividends in an amount that has exceeded 3 times MOIC. So how does that affect the dynamics? They've gotten their money back in a good IRR already. So does that mean they're patient and not so concerned about the incremental dollar, or do they view it as the golden goose and this is the one they need to ride and need to maximize it?
Probably both to some degree. So I guess I would say globally, and there's a lot of overlap with across our different businesses with our investor base. And I would say Austin and I have been incredibly fortunate to have supportive, intelligent, I wouldn't say over-engaged, but investors who are willing, if there's something we think they can help with, they've every time been willing to jump in and be helpful. I think for the most part, like when we bought Acme, the cap table, I told you the purchase price was 7.5. There were some fees and expenses. So I think there was $2 million of equity that went in and $6 million of debt. And those folks that invested with us, I don't think for any of them, they were taking a speculative bet with money that they couldn't live without. 2 of the larger investors are the former owners of the business. I think they reinvested because they were required to for the transaction, and they assumed that they would get zero from that. They never said that explicitly, but I think that they discounted very heavily the likelihood that they would ever see another cent out of it, and it's been quite good for them at this point. And I think that's pretty representative of the types of investors that we have in it. There's generally smaller check writers, and Salem's one notable exception as an institutional investor. We have one family office that's in there. Again, all super patient, super supportive. And of course, I don't think anyone wants to leave money on the table. We've done a couple deals recently, competed in one where we know we matched the market clearing price, but as an independent sponsor with financing contingencies, weren't able to win the deal. We've got a pretty good sense on where these things trade. Talk to all the bankers we know that are selling them.
You mentioned that your investors are not, you're fortunate to work with them and they're not over-engaged. What does an over-engaged investor look like?
Weekly, bi-weekly, give me an update. That'd be my sense. I mean, our folks, our cadence of, frankly, our cadence of investor updates probably leaves a little something to be desired. We aim for quarterly and are usually able to do semi-annually. And probably once a quarter we'll get an inquiry of some kind from somebody, like one person. It's just they have delegated the management of these investments to us and seem to trust us to do it, and we make every effort that we can to treat them fairly and do right by them, and they're not swooping in very frequently at all, which is great. And then when we have something where they can help, they're amazing. I don't know how to quantify it beyond that. Is that helpful in terms of an answer?
Oh, thank you. I think what I'm hearing is everyone around the table needs to be tactful about their intensity and cadence, and just be a good partner. And being weekly checking in about operational status would perhaps be excessive if you're a minority shareholder.
I think so. We've never had someone do it. So yeah, but it does feel to me like that would be excessive if you're spending a disproportionate amount of your time reporting out on what you're trying to do. You're just doing less. Right.
Yeah, that's a good way to put it.
GR, we're about to let you go, but wanted to ask one last question about employees. So we've already talked a little bit about EOS, but employee engagement, ownership in what you all are building is a part also of the kind of ethos of Stacker. Talk to us about how you approach that.
Yeah, well, I think you saved the best question for last, in my opinion, or at least the topic that I'm most excited to talk about. We've had the opportunity to see firsthand at Acme over time as we implemented a variety of different efforts to align the interests of the employees in the building with the ownership group, communicate them really clearly. So part of that is equity grants. Part of that has been a really transparent and fairly broad bonus program that gets reported out on a monthly basis. And then part of that is a plant floor gain sharing program. So those are the three legs of the stool that we've done. The engagement level, the performance level, profitability, almost any metric that you can measure has improved. I mean, they all haven't been a straight line up, but generally the trend line since we implemented these different gain sharing, profit sharing measures, et cetera, has been phenomenal. And it I don't run a regression on it, but it seems to be more than just correlation. There seems to me to be an element of causation. We're now trying to repeat that. We're studying really closely what the folks at KKR and Ownership Works are doing, alternately kind of begging, pleading, trying to cajole and coerce them to share as much of their playbook with us as they can. We've replicated the broad-based kind of employee ownership program that KKR is executing pretty consistently with their portfolio businesses at our most recent company. Austin's led that effort. He'd be in a better position to speak exactly to it. It's way too soon to tell what sort of results we'll get from it, but we're certainly getting engagement and questions. And I think at a super high level, I know we're near the end here, but our perspective on it is on kind of a simple foundational level. It's the right way to do business. Both Austin and I enjoy what we're doing much more when we're doing it this way. We're seeing an impact in the lives of our employees, and then consequently we're seeing the businesses perform better. And on some level, like the whole level of dialogue gets elevated, where if we rewind 5 years, 6 years, we were having conversations about, I need 50 cents more. And when I was running Acme, it was probably weekly, every couple weeks, someone would come up to the front office and try and negotiate a raise. And fast forward to today, we're paying in these good gain sharing months, we're paying way more to employees than they would have ever thought to come in and ask for. And again, I think that stuff gets the flywheel spinning, and it starts to spin faster when folks feel like, hey, this is great. When the company's doing really well, I feel it. And when the company's struggling a little bit, I feel it too. And now I'm thinking about, what can I do to get us back to where we were when I was getting a $400 check at the end of the month, or a $350 check at the end of the month? So for us, it's been really satisfying. And when we decided to do all this, outcomes were certainly uncertain. So looking back at it now, after a couple of years, seeing that this has resulted in innumerable benefits, and has helped our employees achieve personal and professional and financial goals, it's super satisfying. I think it's given us a template to work with as we go forward. Exactly how it takes shape at each business will probably vary, and it's something we spend a lot of time thinking about and trying to figure out, and something that we're truly deeply passionate about. So I should have figured out a way to lead off with that, but I'm glad we covered it and got it in before the end here.
But this is separate from EOS, right? It's a different type of initiative. And the KKR playbook that you mentioned, what are some of the highlights there that you have learned without actually getting access to it?
We can't get it. There's a hilarious little outtake at the end. They did a wonderful piece on 60 Minutes, which anybody could Google and find. And Austin's big debut to the world was sort of tracking the KKR people to an elevator at a conference, and he ended up in the 60 Minutes segment trying to bird dog them and see if he could coax them into giving us some more of the information. So we have not been able to get a ton from them. Different folks in the organization, we were kind of putting puzzle pieces together as we learn more and more about it. We don't know exactly how to do it. And I think some of the conversations we've had have been really encouraging for us, because there's clearly an experimental entrepreneurial spirit at KKR where they're very open about, we're trying to figure it out too, you guys. So there are not necessarily two tablets that we can just hand you and you can go do this. These are the core principles. We think that when people have a sense of ownership, and they're generally not transferring actual equity ownership in the business to employees, it's more like a transaction bonus that you need to still be employed at the company at the time that there's a liquidity event. And the rewards can be pretty significant. They're targeting at KKR. I don't want to overstate. I'm not a representative of the firm. I think their goal is to get to half of a year's comp and transaction bonus for kind of a rank and file employee. And if the company, that's if you had plan. If you go way beyond plan, obviously those numbers can multiply from there. So we can work spreadsheets too, and we're trying to come up with mechanisms that would get our folks to the same places, and we've had our attorneys draft documents that are probably not as elegant as the ones that KKR has, but I think we understand the basic gist of it, and different folks on their team have been really generous with their time and kind of explaining some of the basics to us, and we're doing our best to copy it, and we think it's a great idea, and ultimately, if we can come up with ways, whether it's that program or the stuff that we've done at Acme, if we can come up with ways for our folks to understand that they, first and foremost, that they are valued and we appreciate them as human beings, we appreciate them as workers, We're grateful that they're showing up, and we want them to succeed as well. We're not trying to keep them under our thumb. We're not trying to squeeze everything out of them and not share any of the rewards with them. We want them to succeed when the business succeeds. We found it just creates a culture where people are much more bought in, and like I said, that kind of the dialogue elevates, and people are having conversations on their own about how to make the place better, and sometimes even the folks on the floor we've started to see people bringing in friends and family that they think are great workers, and it all builds on itself, and like I said, compounds over time. So we're big believers that when we win, everybody ought to win. Our investors should win, the employees should win, and if we can create that culture where we know the employees are winning as well, I think the investors do even better.
Great note to end on. G.R. Kearney, thank you for joining us on the Minds Capital podcast and giving us a picture into how you've built it from kind of interesting beginnings and your passion for EOS and employee ownership. Great to learn from. Really appreciate your time.
My pleasure. Really appreciate you having me. Thanks so much, guys.
Hope you enjoyed that interview. For more like it, subscribe to the Minds Capital podcast wherever you listen to podcasts. You can also watch us on YouTube. Also check out Minds Capital, where Nicholas and I are partners alongside Max Lummis. We invest equity in independent sponsor deals. So if you're a sponsor with a deal under LOI, please visit mindscapital.co to start a conversation. There's also an investor tab on our website with information about future fundraisers. See you in the next episode.